The Reserve Bank of India is currently managing an immense influx of foreign capital. Over $40 billion has poured into the country through foreign currency non-resident bank deposits. This surge in external cash directly bolsters the Indian rupee, providing a strong defensive buffer against fluctuations in the US dollar. This headline from the Economic Times shows that domestic tax revenue is matching that momentum, with July's GST collections rising 15%. This combined growth creates a highly effective double engine for the broader economy. This deep pool of liquidity signals a deliberate move by non-resident Indians to route their wealth back home, demonstrating long-term confidence in the country's financial stability. That massive pool of capital is now rotating out of traditional savings accounts and hunting for yield in highly specialized sectors. This deep dive illustration captures one of the largest targets: private education. Over the past decade, private equity firms have channeled over $1.5 billion into Indian schools. To understand how they extract value, look at this breakdown of the OpCo-PropCo model. Investors split the school in two: an operating company handling the teaching and a property company owning the land. Private equity buys the real estate, then leases it back. Managing teachers and curriculums carries significant operational risk. Collecting rent is a far more stable venture, allowing investors to secure a predictable 10 to 12% annual yield. The end users guaranteeing those steady returns are students in urban centers, backed by a rapidly expanding middle class paying a premium for top-tier infrastructure. By applying corporate structuring to classrooms, smart money has successfully converted education into a reliable commercial real estate asset class. The next major capital rotation prioritizes velocity over physical buildings. Quick commerce platforms like Zepto built sprawling logistics networks to deliver groceries in under 10 minutes. This timeline tracks the rapid succession of funding rounds, pushing Zepto toward a pre-IPO debut. The willingness of major backers to finance this final push signals that investors are ready to deploy aggressive capital into consumer tech once again. Urban consumers have consistently demonstrated they will pay extra for immediate convenience. Capital is now backing the logistics required to monetize that impatience. In healthcare, a specific class of medication is dictating the flow of money. The arrival of GLP-1 weight loss drugs has triggered a surge in hiring across the medical sector. Hospitals are expanding their services beyond basic pharmacy sales by investing in specialized dietitians, hiring clinical nutritionists, and behavioral therapists to support long-term treatment plans. This chart shows the scale of this shift. While standard medical hiring continues at a steady pace, the demand for specialized obesity care roles diverges sharply upward. Clinics are actively reconfiguring their floor plans and payrolls to capture revenue from a billion-dollar lifestyle management market. Finally, we reach the edge of the knowledge economy. Artificial intelligence generates digital output with mathematical precision, making flawless text and code cheap and abundant. This Sunday Chatter column highlights a countertrend: the concept of the flaw as a signature. When perfection is entirely automated, human imperfection carries a distinct market premium. A machine can synthesize massive amounts of data, but it cannot offer lived experience. That authentic, unreplicable perspective is becoming the rarest commodity in the workforce. The market is now shifting its rewards towards those who leverage a unique human signature, rather than attempting to compete with algorithmic efficiency. From the $40 billion anchoring the Reserve Bank, capital is cascading through the economy. It is securing classroom real estate, building 10-minute delivery networks, staffing obesity clinics, and pricing the human premium. The underlying strategy is clear. The Indian market is rewarding investors who identify scarcity, whether that is physical infrastructure, time, or authentic experience, and adapt their capital to own it. Thanks for watching. For more insights on where the capital is moving next, make sure to subscribe to Trade Express.